Hello and welcome students. In the last video lecture, I had completed the first adjustment related to admission of new partner out of the 5 topics that we had discussed. That is to find the new profit sharing ratio and the sacrifice ratio. Also we had done few practical sums related to that. Now in this video lecture, I am going to discuss the second topic, that is accounting treatment related to goodwill. There are 6 different situations in which the accounting effect differs related to goodwill. First of all, let us discuss the first situation, that is when goodwill is paid privately by new partner. It means the new partner is admitted in the firm, and instead of bringing that goodwill in the firm, he directly gives privately to the existing partners without bringing that goodwill in cash in the firm. So what would be the journal entry for it? For understanding that, I am discussing question 4 of your textbook, that is on page number 205. Question number 4.1, that is related to the first situation of goodwill. That is when the goodwill is brought privately by the new partner without bringing it in the firm. It is directly given to the existing partner. So first of all, let us read the first question of question number 4. First question, A and B are partners sharing profit and loss in the ratio of 3:2. It means the existing partners are A and B, and they are sharing the profit and loss in the ratio of 3:2. It means the old ratio is 3:2. They admitted C as a new partner. The new partner that comes in the business, that is partner C, for 1/5 share of profit. What is the new share of the new partner? That is 1/5 share of profit. C brings rupees 80,000 as his capital in cash. We had already discussed that if new partner gets admitted, he has to bring capital also as well as goodwill also in the firm. C gave his share of goodwill personally to A and B. It means he has given privately to the existing partners, that is partner A and B, instead of bringing that goodwill in cash in the firm. There was a balance of goodwill rupees 25,000 in the books of firm before C's admission. It means before C was admitted in the firm, already goodwill that was existing in the firm that has been earned by the existing partners A and B, that is rupees 25,000. Now this 25,000 that was existing before the admission of the new partner, that is to be distributed amongst the old partners in their old profit and sharing ratio. The reason, because that goodwill is earned only by the existing partners. So new partner will not have the share in that old goodwill. So always that old goodwill that was existing before the admission of the new partner will be distributed amongst the old partners in their old profit and loss sharing ratio. So here first of all we will discuss the journal entries. The main important topic, we have to write the journal entries over here. So first journal entry, that will be for distribution of the old goodwill among the old partners. What are the old partners over here? That is partner A and partner B. Now what is the old profit and loss sharing ratio? That is given in the question, that is 3:2. So goodwill, that is 25,000. So that 25,000 we have to distribute in the ratio of 3:2. So 25,000 distributing in the ratio of 3:2, it would come to 15,000 and 10,000. Now who are the receiver? That is partner A and partner B. So debit the receiver. So entry would be A's capital account debit, B's capital account debit to goodwill account credit, because now that goodwill goes to the partner, so that much amount of balance will be decreased in the firm. So goodwill account will be credited. So to goodwill account credit, that is 25,000. So this was the only entry that is to be written in case when the goodwill is paid privately by the new partner to the existing partner, because there would be no any entry in the firm related to the goodwill that is paid privately by the new partner to the existing partner. So only one entry would come, that is related to the old goodwill that was existing in the books before the admission of the new partner. So that was the first situation related to accounting effect of goodwill. Now moving on to the second point that I have written over here. Second point, when goodwill brought in cash by new partner and it is retained in the business. It means goodwill is brought in cash. In the previous first situation, goodwill was not brought in cash by the new partner. It was directly given to the existing partners privately. Now that goodwill brought by the new partner is coming in cash in the firm, and it is retained in the business. That goodwill is kept in the business. So what would be the journal entry in that situation? For that, let us understand question number 4.2 of your textbook. I am taking, there are total 6 situations and 6 different sums I will be taking related to goodwill, so that each and every topic will be easily understood to you. So let us read question number 4.2, that is on the same page 205. A and B are partners in a firm. C admitted as a new partner. What are the existing partners? Old partners, that are A and B. C is admitted as a new partner for 1/4 share in profit. What is the share of the new partner? That is 1/4 share. C brought rupees 80,000 as his capital and his proportionate share of goodwill in cash. Now C is bringing capital, that is rupees 80,000 in cash in the business, and proportionate share in goodwill. Now what is this proportionate share? That we have to find over here. Goodwill of the firm is valued at rupees 1 lakh. What is the goodwill? Total goodwill. The 1 lakh that is given to you, that is the total goodwill. Now out of that 1 lakh, what would be the share of the new partner? That we have to find out. Now over here it is given to you that goodwill is total 1 lakh. Out of that, the new partner's share, that is 1/4. So 1 lakh multiply by 1/4, it would come to 25,000. So 25,000 is his share in goodwill. So 80,000 he is bringing as capital and 25,000 that he is bringing as goodwill in order to get admission in the firm. Okay, so the first entry, that would, here the old goodwill is not there. You can see goodwill of the firm is valued at rupees 1 lakh. So the first entry you can see over here, that is he is bringing in cash. What he is bringing in cash? That is 2 things that he is bringing in cash. That is capital and goodwill. One thing I want to make it clear, whenever there is old goodwill before the admission of the new partner, in that time we are writing only the word goodwill. But in case when the new partner brings his share of goodwill, then we are writing the word that is premium for goodwill. That is called premium for goodwill. But we don't just write only goodwill. We write premium for goodwill. So the first entry, when he brings in cash 2 things, that is capital and goodwill. What would be the journal entry for it? You can see on the board. The first journal entry that I have written over here for 4.2, that is cash account debit, because that much cash comes in the firm. So debit what comes in. So cash account debit 1,05,000. To C's capital account, that is already given the question, that is 80,000. To premium for goodwill account credit, that we have found out, that is his share of goodwill, that is 25,000 out of the total goodwill, that was 1 lakh. So this is the first entry, that he brings in cash to different things. Now the second entry, that is that goodwill is to be distributed amongst the old partners in their sacrifice ratio. Again I am repeating, that goodwill is to be retained in the business. Whichever goodwill the new partner is bringing, that is to be retained in the business. It is to be retained, for that it is to be distributed amongst the old partners in their sacrifice ratio. Now you can see in the question, there is no any ratio given to you. If in the question no any ratio is given to you, it means old ratio amongst the existing partners, that you have to consider as 1:1. And if only old ratio is given in the question, then sacrifice ratio is not given, then old ratio will be your sacrifice ratio. It means if in the question sacrifice ratio is not given, or new ratio and old ratio both are not given, if new and old are given, then you can easily find the sacrifice ratio. You are knowing the formula. That is sacrifice is equal to old minus new. But if only old ratio is given in the question, then sacrifice ratio will be equal to old ratio. So over here sacrifice ratio will also be 1:1. Okay. So the second entry, that would be premium for goodwill account debit. What was the goodwill brought by the new partner? that is 25,000. Premium for goodwill account debit 25,000 to A's capital account credit to B's capital account credit distributed in equal ratio 1:1. It means whenever the old ratio is only given in the question, the sacrifice ratio will be equal to old ratio, because we cannot find the sacrifice ratio if both new ratio and old ratio are not given in the question. Okay, clear? So the second entry, that is premium for goodwill account debit to A's capital account credit, that is 12,500, to B's capital account credit, that is 12,500. So these two entries will be coming. The first entry, that is when he is bringing in cash, that is capital and goodwill, and the second entry when the goodwill is distributed, when the goodwill brought by the new partner is distributed amongst the old partners in their sacrifice ratio. Over here sacrifice ratio is not given, so old ratio will become your sacrifice ratio. So this was the second situation related to goodwill. Now moving on to the third situation related to goodwill, that is over here I have written third point, when goodwill brought in cash by new partner. Over here also goodwill was brought in cash by the new partner. Over here also goodwill is brought in cash by new partner and withdrawn by old partners fully or partially. In this second point, this was retained in the business, but over here in the third point, that goodwill is withdrawn by the old partners either fully or partially. So we have to see the journal entries related to that type of situation. For that I am taking fourth question of your textbook. First of all, let us read the question, that is question number 4 on page number 206. That is question number 4.4. P, Q and R are partners sharing profit and loss in the ratio of 3:2:1. It means the old ratio of the old partners of P, Q and R, that is 3:2:1. They maintain their capital account by fixed capital method. We had already studied that is fixed capital method and fluctuating method. In case of fixed capital method, whatever the journal entry is related to capital account, for that will be making the current account. So you can see in the entries that I have written over here, that is current account. The last entry that I have written, P's current account and Q's current account. I have not written P's capital and Q's capital. Okay. So now further, they admitted S as a new partner. The old partners, there were three partners over here, that is P, Q and R. S, that is the fourth partner, is admitted in the firm. S brought cash rupees 50,000, furniture 40,000 and motor car rupees 60,000 as his capital. It means he is bringing three things in the firm in the form of capital. Not only in cash, in the previous two sums we had discussed that he has brought in cash only, capital he has brought in cash form only, but over here he has brought capital in the form of assets also. So he has brought furniture also, motor car and cash, and share of goodwill. It means he is bringing cash, furniture, motor car and his share of goodwill in cash. Goodwill is valued at rupees 2,40,000. So out of 2,40,000, his share, you can see that is they admitted 2,40,000. At the time of S admission, goodwill appeared in the books of the firm at rupees 90,000. Means this is the old goodwill. 90,000, that is before the admission of the new partner. So that is to be distributed amongst the old partners in their old profit sharing ratio. What is the old profit sharing ratio? That is 3:2:1. So the first journal entry you can see over here, that is P's capital account debit, Q's capital account debit, R's capital account debit. These are the old partners. To goodwill account credit. If there is a old goodwill, then only word goodwill will come. But if the new partner brings the goodwill, then the word premium for goodwill that we have to write. Okay, so the old goodwill, that was 90,000. 90,000 that we had distributed in which ratio? That is 3:2:1. So 90,000 distributing the ratio of 3:2:1, it would come to 45,000, 30,000 and 15,000. So always whenever the old goodwill is there, then the first entry that would be for the distribution of the old goodwill amongst the old partners in their old profit sharing ratio. Now the second entry, that is he is bringing in capital and goodwill. In the form of capital, he is bringing three things, that is cash, furniture and motor car. Now you can see that is cash he has brought, that is 50,000 cash account debit, furniture account debit, that is 40,000. This we have to look from the point of view of the firm. Firm is getting all these things, so it would be increased. So debit effect would be given. Cash account debit 50,000, furniture account debit 40,000, motor car account debit 60,000. This much is already given in your question. To S capital account credit. To S capital account credit and to premium for goodwill account credit. Now you can see over here, total of this thing would be 50,000 plus 40,000, that would come to 90,000. 90,000 plus 60,000, it would come to 1,50,000. Now the total goodwill that is given in your firm, in your textbook, that is 2,40,000. So out of 2,40,000, the new profit sharing ratio that is already given to you in the question, you can see that is 4:3:3. 4:3:2:3. It means new ratio is also given to you and the old profit sharing ratio is also given to you. Now the new ratio, that is 4:3:2:3. It means the new share of the new partner, that would be 3/12. So the total goodwill, that is 2,40,000. 2,40,000 multiply by 3 divide by 12. 2,40,000 multiply by 3 divide by 12. So 12 2s are 24. 20 into 3, it would come to 60,000. So the share of goodwill of the new partner, that would come to 60,000. So here you can see I have written 2 premium for goodwill, that is 60,000. Now debit we have done 1,50,000 and credit we have done 60,000. So the remaining, that would be 90,000, that will be considering as the capital of the new partner, that is S. So I hope you have understood this second journal entry. That is 3 things he is bringing in the form of capital, that is cash, furniture and motor car. To S capital account, to premium for goodwill account credit. How you have found the goodwill? Again I am repeating, that is 60,000. For that, total goodwill is already given in your question, that is 2,40,000. Out of that, share of new partner, that is 3/12. So 12 2s are 24. 20,000 into 3, it would come to 60,000. And the remaining difference out of 1,50,000 minus 60,000, so remaining, that would be your capital, that is 90,000. Okay, so second journal entry is clear. Now the third entry, same as that we have done in the second one also. See, premium for goodwill to A's capital to B's capital. It means that goodwill brought by the new partner, that is to be distributed amongst the old partners in their sacrifice ratio. It is to be distributed amongst the old partners in their sacrifice ratio. In the previous sum, no sacrifice ratio was given to you. That's why old ratio we have considered as sacrifice ratio. But in this sum, old ratio is also given to you and even the new profit sharing ratio is also given to you. So we have to find the sacrifice ratio. Students, revise the previous lectures. You can easily understand what is the formula of sacrifice ratio. That is old share minus new share. So we have to find the sacrifice ratio of the old partners. Here you can see sacrifice is equal to old minus new. So for P, it is equal to old ratio, that is 3/6, because 3:2:1. So 3/6. So 3/6 minus new ratio, that is 4/12. So this is for P, Q, R and S. For P, it would be 4/12. So old share, that is 3/6 minus 4/12, that is new ratio. Taking the LCM, that is 12. The answer, that would come to 2/12. That is for P. Now same way we have to find for Q. In case of Q, the old ratio, that is 3:2:1. So it would come to 2/6. So 2/6 minus 3/12. 3/12, that is the new ratio of partner Q. Okay, so 2/6 minus 3/12. Again same LCM, that is 12. So 4 minus 3, it would come to 1/12. Now the third old partner, that is R. In case of R, the old ratio, that is 1/6. So 1/6 minus new ratio, that is 2/12. 1/6 minus 2/12, it would come to 0/12. It means no sacrifice, no gain in case of partner R. So only 2 partners that are sacrificing out of the 3 old partners, that is P and Q. In which ratio? That is 2:1. So the sacrifice ratio of the 2 partners is 2:1. So it would be distributed, the new goodwill brought by the new partner in the ratio of 2:1. So you can see over here 60,000 the goodwill that is brought by the new partner S, that is distributed amongst the two partners, that is P and Q. In which ratio? 2:1. 60,000 you will divide in the ratio of 2:1. It would come to 40,000 and 20,000. So you can see the entry premium for goodwill account debit 60,000, to P's capital account credit 40,000, to Q's capital account credit, that is 20,000. Now up till here we had already studied. Now the main important point compared to the previous sum, that is the last fourth entry. It has been told that partially, you can read the question also, the last line I am reading. At the time of S admission, goodwill appeared at rupees 90,000. New profit sharing ratio is decided at 4:3:2:3. Old partners withdraw 50% goodwill of their share in cash. It means partially they are withdrawing that amount of goodwill that is brought by the new partner in the form of cash, not fully. We have already discussed withdrawn by old partners either fully or partially. Over here they are withdrawing partially. It means 50% of goodwill in the form of cash. So the last journal entry, it is as per fixed capital method. So here I have written P's current account debit, Q's current account debit to cash account, because they are withdrawing. So that much amount of cash will be reduced from the firm. So credit what goes out. So that much amount of cash will be reduced from the firm. So and these two are the receivers, P and Q. So P's current account debit, that is 40,000, half of 40,000 would come to 20,000, and half of 20,000 would come to 10,000. So 20,000, 10,000 to cash account credit, that much 30,000 out of total 60,000 goodwill. Half of the goodwill that is withdrawn by the old partners, that is P and Q, in their sacrifice ratio. So the last entry over here, that is P's current account debit 20,000, Q's current account debit, that is 10,000, to cash account credit, that is rupees 30,000. So here the important point, that was the goodwill that was withdrawn by the old partners partially. Now moving on to fourth situation related to accounting treatment of goodwill. You can see on the board I have written the fourth situation, that is when old partner does not bring goodwill in cash. It means the previous sum, it was there that the new partner is bringing the goodwill in cash. Either it was retained in the business or it was withdrawn by the old partners fully or partially. That topics we had discussed. Now this goodwill that is bringing in the new partner, that is not bringing goodwill in the cash. It means whatever is the share of goodwill in the firm of the new partner, that is not bringing in cash. So for that I have taken question number 9 of your textbook, that is on page number 206. Let's read the question. Ninth question, A and B are partners sharing profit and loss in the ratio of 3:2. There are two partners, old partners, that is partner A and B, and their old profit sharing ratio, that is 3:2. They admitted C as a new partner for 1/5 share. Now the new partner C is admitted for 1/5 share in profit. C brought rupees 30,000 as capital in cash, but he could not bring his share of goodwill rupees 10,000 in cash. It means he is bringing capital share, but he is not bringing the share of goodwill, that is rupees 10,000 in cash. It means the fourth point that I want to discuss, that is when old partner does not bring goodwill in cash. It means his share of goodwill that is not brought by him in the firm. So there is the share is given of the new partner, that is partner C, that is 10,000, but he is not bringing that share of goodwill in cash. For this type of sum you can even refer illustration number 15 of your textbook, that is similar to this sum of question number 9. So A and B are partners sharing profit and loss in 3:2. They admitted for 1/5 share. C brought 30,000 as capital in cash. The first entry you can see whatever he is bringing in cash. So cash account debit, because it would come in the firm. So debit what comes in, so cash account debit 30,000 to C's capital account credit, that would be 30,000. So 30,000 capital he is bringing in cash. Now the second entry you can see over here, that is C's capital account debit to A's capital account credit to B's capital account credit. Now what is the share of goodwill, that is 10,000. That 10,000 he is not bringing in the firm. So it is due for the firm. So his capital account, his capital matlab new partner's capital account will be debited by rupees 10,000 to A's capital to B's capital. That will be distributed amongst the old partners in their sacrifice ratio. Over here you can see only the old ratio is given to you. I had already discussed, if only the old ratio is given to you, the old ratio will always be the sacrifice ratio. So here it will be distributed in the ratio of 3:2. So 10,000 you will divide in the ratio of 3:2, it would come to 6,000 and 4,000. So these are the two journal entries. Again, the first journal entry when he is bringing the amount of capital in cash, and for the second entry he is not bringing the goodwill, his share of goodwill in cash. In that case, whatever the amount of goodwill of his share will be distributed amongst the old partners in their sacrifice ratio. Okay, so up till now we have discussed fourth situation of related to goodwill. Now the fifth situation that you can see I have written over here, when goodwill is valued on the basis of net worth or capital of partners, it means the goodwill value is not given to you, but there is hidden goodwill. To find that hidden goodwill, I have taken one sum of the same exercise, same question, that is 11th sum. You can see over here 11th sum I am reading. Capital of G and E is rupees 80,000 and 60,000. It means the existing partners or the old partners that are partner G and E, and their capital is given to you 80,000 and 60,000. They admitted B as a new partner for 1/4 share in profit. Means the new partner is partner B, and his share of profit, that is 1/4 share. B brought rupees 50,000 as his capital. His share of capital is given to you, that is 50,000. Calculate goodwill and pass necessary journal entries. It means goodwill is not given to you, but you have to find the hidden goodwill. How to find the hidden goodwill? We'll learn now. Okay, so first of all you can see over here, for 1/4 share, 1/4 share is of the new partner. Who is the new partner? That is partner B. That partner B is bringing the new goodwill, that is bringing the share of profit, that is 1/4 share of profit. So for 1/4 share of profit his capital is rupees 50,000. Then for one full share, how much would be the total capital? So you can find the total capital, that is 50,000 into 4. 50,000 into 4, it would come to 2 lakh. So the total capital, that is 2 lakh. But out of that 2 lakh, you can see G and E's capital that is given to you. G's capital is given in the question, you can see 80,000, and of E it is given to you 60,000. And already B's capital, that is the new partner's capital, is also given to you in the question. So all the three partners' capital, when you do the total of it, it would come to 1,90,000. Actual capital should be 2 lakh, but the capital that is brought by these three partners, that is 1,90,000. So the difference of these two, that is the actual capital should be 2 lakh, but brought, that is only 1,90,000. So the difference of these two, that is 2 lakh minus 1,90,000, that would come to 10,000. This is the amount of goodwill. This is the hidden goodwill that we have found out. Okay, understood? This is the main important point, that is hidden goodwill. Directly the value of goodwill is not given to you in the question. We have to find the value of goodwill by finding the difference of this two value of capital. So now out of that 10,000, the share of the new partner in goodwill, that is 1/4 share. So 10,000 multiplied by 1/4, it would come to 2,500. So the share of goodwill of the new partner, that is 2,500. This 10,000 is the entire goodwill of the whole firm. But out of that, the share of goodwill of the new partner, that is only rupees 2,500. That we have to distribute amongst the old partners. So now we are referring to the journal entries. The first journal entry you can see over here, that is B's capital account debit. Who is B? That is the new partner. So B's capital account debit, that is 2,500. That goodwill of the new partner is distributed amongst the old partners in their sacrifice ratio. Now you can see in the question, old ratio is not given. If old ratio is not given, then it is to be understood as 1:1. And if sacrifice ratio is not given in the question, then old ratio will be your sacrifice ratio. So over here, the goodwill of the new partner will be distributed amongst the old partners in their old ratio, that is 1:1. Okay, so B's capital account debit, total goodwill of him is, that is 2,500, to G's capital account, to E's capital account, distributed in equal ratio, that is 1,250, 1,250. Now the second entry, that is he is bringing the amount of capital in cash. How much the new partner is bringing? You can see in the question that is 50,000 capital he is bringing in cash. So very simple entry when he is bringing the capital in cash. So cash account debit to B's capital account credit, that is 50,000. So here important point that we had understood, that is how to find the hidden goodwill. By finding the hidden goodwill, we will find the share of that new partner, and that share of new partner will be distributed amongst the old partners in their sacrifice ratio. And if the sacrifice ratio is not given to you in the question, then old ratio will be considered as the sacrifice ratio. Students, 5 points we have completed now. Now moving on to the 6th point. That is, you can see over here I have written, when only a part of premium of goodwill brought by new partner in cash. Which means out of the total goodwill that he has to bring for admission in the firm, is bringing only a part of that goodwill in cash. For that I have taken question number 13 of your textbook, that is the last question of question number 4. So first of all, let us read question number 13. X and Y are partners sharing profit and loss in the ratio of 2:3. What is the share of the two partners, that is X and Y, that is 2:3. They admitted Z as a new partner for 1/5 share. Now the new partner, that is partner Z, and he is admitted in the firm with 1/5 share in the profit. Goodwill is valued at rupees 20,000. Balance of goodwill appeared at rupees 15,000 in the balance sheet. It means before the admission of the new partner, the existing goodwill that was in the firm, that is rupees 15,000. So that is to be distributed amongst the old partners in their old profit sharing ratio. So this 15,000 that would be distributed amongst the old partners. Who are the old partners? That is partner X and Y. So it will be distributed in the ratio of 2:3. So X and Y, 15,000 distributed in the ratio of 2:3. It would come to 6,000 and 9,000. So the first entry, that would be distribution of the old goodwill amongst the old partners in their old profit sharing ratio. So first entry, X capital account debit 6,000, Y's capital account debit 9,000. To goodwill account credit, that would come to 15,000. Now whatever he is bringing in cash, that is either capital or goodwill. Over here Z brought rupees 50,000 as his capital and 80% of his share of goodwill in cash. Now what is the total goodwill? Total goodwill that is given to you, that is 20,000. Out of that 20,000, his share, that would be 1/5. So it would be 4,000. Out of 4,000, it is told that 80% he brought in cash. So 4,000, 80%, it would come to 3,200. So this much amount of goodwill that he is bringing in cash, and 800 remaining amount out of 4,000 minus 3,200, 800 that he is not bringing in cash. Okay, so the second journal entry, that is cash account debit 53,200, that is total of capital and goodwill. Capital that is bringing 50,000 and goodwill out of 4,000 is bringing only rupees 3,200. So cash account debit, total of this two, 50,000 plus 3,200, it would come to 53,200. To Z's capital account credit, to premium for goodwill account credit 3,200. Now the third journal entry, that is that goodwill is to be distributed amongst the old partners in their sacrifice ratio, and if the sacrifice ratio is not given, then it is to be distributed amongst the old ratio. Over here you can see premium for goodwill, that is 3,000. I have not written 4,000 because that new partner has brought only 80% of his goodwill. So 3,200 he has brought his goodwill, and the remaining goodwill that is debited to his account. His account means new partner's account. Who is the new partner? That is partner Z. So that new goodwill difference, that is out of 4,000 minus 3,200, remaining, that is 800. That 800 is due from him still. It means it is to be received from him. So his capital account will be debited by rupees 800. So the journal entry, third journal entry, please pay attention. This is the new point over here. Premium for goodwill account debit 3,200, Z's capital account debit, that is 800, to X capital account, to Y's capital account credit. Now I had already told that this new goodwill of the or new partner, that is to be distributed amongst the old partners in their sacrifice ratio. But here in the question again the new ratio or the sacrifice ratio is not given, so it is to be distributed in the old ratio, that is 2:3. So 4,000 that will be distributed in the ratio of 2:3, so it would come to 1,600 and 2,400. Now the last point, that is the fourth journal entry. For that I am reading the last line of the question. After the admission of Z, it means the third partner Z is admitted in the firm. Of the first year, the profit of the first year of the new firm was rupees 60,000. Means after the admission of the new partner Z, the new profit of the firm that came to 60,000. Now this is new profit. If this is new profit, so it will be distributed amongst the new partner also. So now the new profit sharing ratio, that would be also 2:3, and over here it would be 1/5 share. So 60,000 that would be distributed amongst the three partners including the new partner. So the journal entry, that would be P&L account debit 60,000, to X capital account credit 19,200, to Y's capital account credit, that is 28,800. And what is the share of the new partner? That is 1/5 share. So 60,000 multiply by 1/5, it would come to 12,000. So to Z's capital account credit, that is 12,000. So this was the main two journal entries which are new from the previous sums. Now we have completed the second adjustment related to the admission of a partner, that is accounting effect related to goodwill. Students, please revise these all 6 questions, again revising from the video lecture. In the next video lecture, we'll be continuing the main important sums, that are the bigger sums which are very important from the examination point of view, board examination point of view. So till then, keep practicing, stay blessed, goodbye.